SD Bullion.
Welcome to the SD Weekly Metals and Markets Review. This is the Doc with Eric Dubin. We had another wild week in the markets as Cypriot depositors were wiped out and decapitated by the ECB and the IMF. And we had chaos late Thursday and into Friday in the gold and silver markets as crazy algos or futures feeds left the gold and silver community wondering what the spot price was for gold and silver. So let's start right off with the metals, Eric. We've made it through options expiration, yet gold is traded back under 1600 and silver tested 28 throughout the week. What do you make of the week's action in gold and silver?
Well, the mainstream media would probably love to continue with their meme of saying that the gold and silver bull markets are over and we're just in the process of drifting downward. But when you look at trading like, for example, on Wednesday, where we had upside reversals, and we're going to include a chart on that as well, too, just to recap it, so radio listeners tune in to the website and look at that. You can see very clearly that silver bounced very strongly off of the lower area of 28, and gold, in fact, even made it over 1,600 once again. So the dip buyers are there, and normally you'd expect a heck of a lot of buying in precious metals when you have, say, a small little event like a banking crisis in Cyprus and the threat of it spilling over into all of Europeans, southern nations. But Powell and have been very aggressive in capping the market. It's clear that that's going on. Perhaps that'll be more visible when we have things like the COT reported and so forth, but just basic common sense should lead any trader to make that conclusion. Bottom line is that the metals are holding their own. The powers that be obviously would love to see them a lot lower given how aggressive they have been over the course of this last 6-month period or so when they've been aggressively capping the market. It's just another week. We see an options expiration on gold keep April's contract below the 1,600 level, which hosed a heck of a lot of people going long in anticipation of profiting from the Cyprus mess. Yet one more signal that we can look to see the footsteps of the cartel in action. Next week, I would suspect that we might see a little bit more calm when it comes to the whole banking crisis rollout as it has hit the news front. That calm is going to be the calm before the next storm, and whatever nation comes and fills in center stage is yet to be seen. It ain't over yet. That lady hasn't sung.
And obviously the big story this week was the Cypriot depositor haircut. The banks finally reopened Thursday at noon local time after they've been closed just under 2 weeks, Eric. The latest news tonight, Friday night, is that the Cyprus Popular Bank depositors are going to be reportedly completely wiped out, over 100,000 euros. So originally the new deal was 40%, then it was up to 80%, and now it's complete wipeout for the big depositors.
Yeah, and what that clearly suggests is that the hole is a lot bigger than what we were being told initially. Whether it's derivatives or larger position in Greek bond exposure, who knows? But obviously, there's
the Russians withdrawing their funds over the week and a half that the banks were closed.
Yeah, that too, exactly. Maybe the Cypriot legislators were making a backdoor open so that mafiosa can claim their money without calling up the hitman as the next phone call.
Right. So the story really kind of morphed as the week went along. I think it was Monday that we had the infamous quote by Deceptive that Cyprus was the template for the Eurozone. And as the week has gone along, on Wednesday we broke the story that Canada actually has kind of buried depositor bail-in haircuts into their 2013 budget that was written about a week ago. Obviously, that was put on the table well before Cyprus began to be included in their official budget. And then this evening, Friday the 29th, we broke the story at SD that the FDIC and the Bank of England created a resolution authority for unlimited Cyprus-Style bail-ins for systemically important banks, and that was completed in early December of last year, so about 4 months ago. So clearly, this whole bail-in depositor haircut is not a one-off in Cyprus. It's a completely coordinated new policy shift among the Western central banks.
Yeah, and the provisions that are within Dodd-Frank that are circa 2010 and the UK bank out legislation previous to that also point to the fact that policymakers are fumbling around trying to figure out ways to shift attention away from the printing as means of resolving bank insolvency towards the depositors. But the ironic thing about this is that the size of our problems in the banking system are so vast that even if, for example, J.P. Morgan, with their derivative book of some $70 trillion of notional value, were to see a 2% haircut, there's not enough depositor money in Chase Manhattan Bank throughout J.P. Morgan's system to bail it out. So it remains to be seen exactly what will evolve. If we have a full-scale crisis, these efforts are not going to be able to patch over and band-aid the system. It's clear that the powers that be are attempting to address the problem proactively, basically by stealing and doing away with the whole 70-plus year history of making sure that the little guy is protected with depositor insurance. But at the same time, it almost seems like Keystone Cops here, because the system and its problems are so large that even these efforts are not going to be able to deal with it. It remains to be seen how this all unfolds, but the question is to what degree the policymakers are in control. I'd have to say that, yeah, they're planning on coming after us, but I don't think they really have figured out how to navigate these turbulent times, and it probably is going to blow up in their face given history and the way these things unfold.
Talking a little bit before we came on the air, that this policy is so idiotic that there's really only a couple of options of what they're likely pursuing here. I mean, either these central bankers are just complete and total idiots and have no idea what they're doing, which is possible. The other potential is that they could be attempting to scare large money and depositors out of the banks and into the stock markets, the bond markets, and the real estate markets to prop up the markets. But if that's their play here, they're really going to be in trouble in my mind. That once the snowball starts rolling, once the avalanche of fear and panic starts rolling, I don't think they're going to be able to stop that. And as you mentioned, the derivatives market, for example, J.P. Morgan, the last time I saw, I believe their derivatives book is $76 trillion or something like that. So
yeah, it's in excess of $70 trillion, which for our listeners' perspective is over 5 times the gross domestic product of the United States on an annual basis. I mean, it's just gigantic.
So we can have 100% depositor haircuts for every client at J.P. Morgan, customer at J.P. Morgan Chase, the retail arm, and they're not coming up with $76 trillion. So it'll be interesting to see where this goes from here, especially as the news spreads next week. That throughout this week, the mainstream media in the U.S. was really attempting to paint the picture that this couldn't ever happen here. What happened in Cyprus, that could never happen here. And while I'd still like to think that's unlikely in the U.S. and the U.K. and Canada, it appears that the central bankers are putting everything on the books to prepare the policy. So it's possible that the next banking crisis that we have, we won't have QE to infinity. We'll have an experiment of haircuts.
Or maybe a little bit of all of the above,
right.
Given the size of the problem and the potentiality for things to spin out of control. I mean, to some extent, the policymakers are basically reinvoking that whole Robert Rubin, Greenspan, Larry Summers, Masters of the Universe type of solution, where they basically try to stall for time, try to massage confidence higher such that juices animal spirits in the stock market, creates a wealth effect, and hopefully in turn creates more economic activity in the United States and broadly defined around the world, such that governments find more taxes because of capital gains and economic activity, and so on and so on and so on. The trouble is that formula, while it worked before when we had far less aggregate debt and far less of a problem with the global derivatives time bomb that we're sitting on now, it is not capable of meeting the needs of where our system is now. We have swallowed way too much debt. The whole concentration within the financial systems around the world, particularly within the Western financial banking establishment, is such that it is now so top-heavy, like Exeter's pyramid with gold at the bottom and all of these fiat-based relationships at the top in an inverted pyramid. It is now in the process of tumbling down, and ultimately there really isn't much that the powers that be could do. They seem to be putting strategies together and putting them on the shelf such that they can hopefully take off the shelf whatever they choose that will effectuate the greatest wealth transfer to the elite and protect them, yet at the same time pay very little attention to the common man and the Western, or frankly, I shouldn't even say Western economies. This is worldwide. 2013 looks like it is going to be part of the end game. We may not see a complete crash this year, and in fact, I doubt we will, given the scale of money printing that's going on. As 2014 to, say, the 2020 window come ever more clearer into focus, the end game of all of these possible off-the-shelf regulation tricks that the powers that be can use, in conjunction with this whole theme that we keep coming back to about the reserve status of the dollar being transitioned away and global systems being reset universally, we're beginning to see the picture of what the end game looks like, and it's not a pretty picture.
And I think most of our listeners probably understand that.
Yeah.
But for those who don't yet and are still sitting on the fence, if you're a depositor in a Western bank, really in anywhere in the Western banking system, it's come time that you don't want more than the insured amount in your accounts. Especially when, I mean, it's not like interest rates are 15% now. You're making, 0.1% an interest with inflation, real inflation, somewhere around maybe 7 to 10%. Now we have the FDIC and the Bank of England explicitly stating that you are in line as a creditor to receive the first haircut if your bank fails. Really, the only protection is real assets, whether that is real estate or I think you and I would both believe that gold and silver, maybe a little bit of platinum, palladium, the monetary metals would be the place to park your assets because there's really no protection left in the banking system.
Yeah, and that brings up another interesting subject as well, too, because for the most part, we haven't really heard anything since Obamacare back in its initial draft of 2010 pertaining to capital controls relevant to, say, coin shops or bullion in general. And that's suspicious as far as I'm concerned. So it's just as a general comment, I'll throw this out here to the listening audience that keep your eyes peeled because I think the next batch of surprises that we're going to be seeing from our lovely leaders are going to be pertaining to capital controls. I'll remind people, too, that when the first draft of the Obamacare legislation was proposed, it included, I believe it was a $500 limit, the requirement of any merchant doing business with anybody, whether it's their customer or their suppliers or whatever, that they would have to file a 1099 with respect to any kind of transaction over $500, which obviously would instantly make the vast majority of coin store transactions reportable and taxable thereafter, should the government wish to increase taxes and capital controls and so forth. It's something that will probably come into the picture as well, too. And, getting back also to the differences between what we can see in a Cyprus versus, say, the United States. In Cyprus, they don't have control over their currency. They're part of the European Union. And as a result, they weren't able to do what the Fed can do, which is to bail out the FDIC simply by printing money. And I've operated on the assumption all along that that's the path of least resistance and least political pain, that we probably would not see the kind of Cypriot bailout fiasco in the context of the United States. But the last week of news and the flip-flops that we saw in Cyprus make me pause and question whether or not that, in fact, is going to be the way things come down in the United States. I believe that the system overall worldwide is unstable to the point where we're going to see something happen stateside and in Western economy. Generically, Spain, Italy, those are probably next on the list, but in the long term...
Discussing that before we came on the air as
right.
well. The mainstream media keeps kind of having, throughout the week, has had the focus on Slovenia, Slovakia, some of those smaller nations.
Right.
But really, it's the big fish. Spain, especially, probably number one, and then even Italy and Portugal that we really should look towards next.
Yeah.
About this all night, and perhaps we should, but let's talk a little bit more about gold. Sinclair's birthday came and went on Wednesday. Have we seen the bottom? I know he said we'd be moving up out of the bottom.
I think, to be fair to his original calls that were in the early February period, we have, in my opinion at least, we've seen the bottom, given the kind of upside reversal patterns we saw and that we're underscoring here for last Wednesday is but one example. He did say that we would not see prices below 1,600 again, and he's wrong on that account, but a few dollars here and there in the grand scheme of things, considering how much pain wasn't visible in early February, not to knock him too hard.
And also, in fairness to Sinclair, when he made that prediction, Cyprus wasn't even on the radar as far as the depositor haircuts. He did say that the bottom would be placed before the 27th, and that it would be in. And I honestly believe that call still will be proven correct. Kind of remains to be seen here, but I think the Cyprus situation will only enforce the long-term bottom. There's actually one of our readers sent us an email that attended Sinclair's meeting, and Sinclair apparently made kind of a surprising remark at his meeting that he admitted that before Cyprus, Sinclair stated that there was actually a possibility that gold could go trade down as low as 1,200, but in the aftermath of Cyprus, that it won't ever really go substantially below 1,600 again.
I would assume that scenario would be associated with a deflationary crash in the financial markets, and it's interesting that he would remain open to that option. Did the reader say specifically why Sinclair had mentioned that target?
It stated that Sinclair admitted that he had never stated it publicly, but he thought the possibility remained that gold could dip as low as 1,200 short term, but after the events of Cyprus, that possibility was entirely out of the picture. All right, Eric. We'll wrap things up there for now, but we're going to keep our eyes really closely tuned on the bail-in situation, as it's really been discovered that the U.S. and the U.K. are in on the whole fiasco and are following the Cyprus template as well, exactly as the Eurozone is that just like the Netherlands have it in the works, and Italy. So really the entire Western financial system is now shifted from quantitative easing to the bail-in method. And as you've mentioned, it may be both, but make sure we investigate the issue further, and as the story continues to evolve and progress, which I'm sure it will over the next week, we'll have quite a bit more for you next week, I'm sure. So that should do it for the SD Weekly Markets and Metals review. This is The Doc with Eric Dubin. Thanks again for joining us, Eric.
Thank you all.